Warren Buffett's Berkshire Hathaway now has a record high $325 billion of cash on hand. This comes after Warren Buffett sold roughly $22 billion, or about 25% of Berkshire Hathaway's Apple stock in Q3. In total, the stake is down 67.2%. So Warren Buffett is dumping Apple shares at the fastest pace you've ever seen before. The question is Warren Buffett bearish on the economy? Is he bearish on markets and what's coming next? I would argue actually probably not. I don't think Warren Buffett is too concerned about the economy personally. I believe he's more concerned about Apple. Apple over the past 3 years has only grown revenue 5%, and it's trading at a 35 times multiple. It's simple as that. Now, some people are going to run away with this and say Warren Buffett is super bearish on our markets. In fact, I've actually been guilty of that in the past as well. To say that Buffett is bearish on our markets because he's dumping Apple, I think is kind of a too simplistic way of actually thinking about this. Now, yes, if there's problems ahead for Apple, which there probably are, I think that's a good sign of problems ahead if Warren Buffett is selling out in the way that he is. That could mean there is problems for the broader market coming because of the market weighting in Apple. On October 22nd, I did write this post on X that says a stock market correction is coming about 10%. I do cite Apple Intelligence and the fact that I think it will flop. And upon early reports of Apple Intelligence, it's just bad. It's just not good. And the expectation is the Apple Intelligence will cause a refresh cycle for the iPhone 16. That's not going to happen. Maybe in the 17. Maybe. In fact, I personally think if we avoid a recession, you're probably going to see a pretty aggressive broad market rally. And if Apple actually disappoints, as long as you're not in Apple, it could actually be to your benefit, as that money may just go into other areas of our markets. Now, I wrote this post on X last night just to share my thoughts as concisely as I possibly can. I say for the next 1 to 2 weeks, we are in a high-risk environment for the stock market. This simply means we have higher odds of a correction via the election sweep or contested election, being the more worst-case scenario. Really, that would just dry up liquidity, right? People would stop buying and they would probably start selling in that scenario of uncertainty, especially if it lasted more than a couple of days. But I also write, there is also the upside scenario. After the election, you could see bond volatility chill out and yields come down a bit. You could see an unwinding of hedges that would be bullish. Again, assuming we know who the new president is, whoever it is, relatively soon after Tuesday. Big tech earnings came in mostly okay, not great enough to bring massive upside to the sector, but enough to hold things up, sure. The jobs report was pitifully bad, but Wall Street gave it a pass. We won't care about it until the next one. We also have the Fed meeting Thursday the 7th. The Fed, I can guarantee, does not like the recent rise in yields. After all, they were trying to stimulate, not tighten. They will sound incredibly bullish. With a fall in bond yields, I would expect a market rally to be a broad one, not just big tech. And the biggest risk we have is a contested election and liquidity drying up. So in the most simplistic way that I can explain this, if we get the results of the election Tuesday night or Wednesday morning, and it's Kamala, then the markets are probably going to rally quite a bit. If we get the results of the election, again, Tuesday night or Wednesday morning, and it's Trump, markets are probably still going to rally. Just because that uncertainty is over with, people will start positioning their portfolios accordingly. If we have a sweep, that is a little bit more of a tricky situation. I don't know how Wall Street will take a sweep. Presumably they would take it negatively, but you could still see a bit of a rally even if we have a sweep. I just think it would be on the smaller side. Now, with a rally, I think it would come because of bond yields falling. Bond yields falling is generally better for the broader markets than it is for big tech. So I think big tech would be the underperformer, and you would see a broader market rally. For Trump, it's going to be a lot of small caps. It's going to be a lot of mid-cap stocks. For a Kamala win, potentially, it's going to be the same playbook as we have seen for 2 years, which would be more larger tech in nature. Now, if we don't know who the president is coming throughout the trading day Wednesday, then you likely start to see some selling. Now, I could also make the argument that the bond market is pricing in a Trump win and treasury yields are going higher, that maybe if Trump does win, especially if there is a Republican sweep, you could see bond yields just go absolutely crazy to the upside, right? Bond yields could run hard. And that's where things get tricky. Does that turn into a negative for markets? Well, so far it hasn't been. So far, it really hasn't affected the markets at all. But I think if you go up materially from here, it does start to weigh on markets. So that could be a negative if we don't see bond yields fall. Now, personally, this does feel like a buy the rumor, sell the news event. No matter who wins, it feels like yields are going up in anticipation of this, and then afterwards they're going to fall. But that's just a hunch. Kind of like if Apple or Nvidia rally into an earnings or rally into some kind of AI event, and that AI event is kind of just what we already know, you tend to get a sell the news event. Well, in Bondlandia, bond prices are actually falling, so people have been selling the rumor, and they may actually buy the news. If you buy the bonds, yields fall, so presumably you would see yields fall. But I do think overall we are in a higher risk environment. If you consider that, let's call it a crash, right? You only get a 20% crash about 25% of the time. So every 4 years or so on average, you get a 20% decline in the history of the S&P, okay? I think we're closer to 50% over the next, 6 months for a 20% crash. That is a heightened, volatility period. Now, I actually want to share with you about a page and a half of this book, The Psychology of Money. It's specifically in regards to Warren Buffett and what he thinks about holding cash on the sidelines. And I think you guys will get a lot out of this. If you have not read this book before, you definitely should. I've read the book a long time ago, but I'm rereading it. But in Warren Buffett's Berkshire Hathaway, we all know Warren and Charlie Munger, but there was also Rick. Okay, Rick, they were like the three musketeers for Berkshire Hathaway. And it says, investor Monish Pabry once asked Buffett what happened to Rick. Monish recalled, and Warren said, Charlie and I always knew we would become incredibly wealthy. We were not in a hurry to get wealthy. We knew it would happen. Rick was just as smart as us, but he was in a hurry. Rick was levered with margin loans, and the stock market went down almost 70% in those 2 years, so he got margin calls. He sold his Berkshire stock to Warren. Warren actually said, quote, I bought Rick's Berkshire stock at under $40 a piece. Rick was forced to sell because he was levered. Charlie, Warren, and Rick were equally skilled at getting wealthy, but Warren and Charlie had the added skill of staying wealthy, which over time is the skill that matters most. It says here, no one wants to hold cash during a bull market. They want to own assets that go up a lot. You look and feel conservative holding cash during a bull market because you become acutely aware of how much return you're giving up by not owning the good stuff. Say cash earns 1% and stocks return 10% a year, that 9% gap will gnaw at you every day. But if that cash prevents you from having to sell your stocks during a bear market, the actual return you earn on that cash is not 1% a year. It could be many multiples of that, because preventing one desperate, ill-timed stock sale can do more for your lifetime returns than picking dozens of big-time winners. Compounding doesn't rely on earning big returns, merely good returns sustained uninterrupted for the longest period of time, especially in times of chaos and havoc. Will always win. Now listen to this. It says 1.3 million Americans died while fighting 9 major wars. Roughly 99.9% of all companies that were created went out of business. 4 U.S. presidents were assassinated. 675,000 Americans died in a single year from a flu pandemic. 30 separate natural disasters killed at least 400 Americans each. 33 recessions lasted a cumulative 48 years. The number of forecasters who predicted any of those those recessions rounds to zero. The stock market fell more than 10% from a recent high at least 102 times. Stocks lost a third of their value at least 12 times. Annual inflation exceeded 7% in 20 separate years. The world's economic pessimism appeared in newspapers at least 29,000 times, according to Google. Our standard of living increased 20-fold in these 170 years, but barely a day went by that lacked tangible reasons for pessimism. Now, this book is really focused on creating, again, long-term wealth, but it does highlight every now and again the risks in the short term for markets. Markets can go down a lot, especially when people are super optimistic, when there's not a lot of risk management taking place, and that's the environment that we are in today. So you have all of these big uncertainties, the election, what's going to happen with the economy, and yes, that does create more risk in the near term of a larger decline. I think we're going to get a 10% correction over the next couple of weeks. But if you use that as an opportunity and prepare for it now, that return that you see, let's say if the markets bounce, right, go down 10%, go up 10%, you might think that's just 10%, but the compounding of that could be thousands of percents over the next 20 to 40 years. But if you're not prepared for that, you are not ready to seize that opportunity. And as I've said here on this channel for the last 2 or 3 months, I do think it is a time to have more cash on the sidelines, to be ready for the inevitable volatility that we are going to see. But you also need to stay invested in markets. So I hear people all the time in comment sections and in, my email that say, because of you, I sold everything and missed the last 2% of the markets. I'm obviously paraphrasing here. You should never sell anything, right? You should always just buy and hold. But if you are able to raise additional cash, that makes a lot of sense right now. Even if we rally into year end, you haven't sold any stocks, you're fully invested from that perspective, you take advantage of that rally, but you also have more cash on the sidelines if the opposite of that happens and markets sell off into year end. Or even in the first half of 2025, I'm more optimistic about the second half of 2025. I think if we are going to get a growth scare, it's probably going to be before June of 2025. I think that's pretty safe to say. And if we can get to midpoint of 2025 without a recession, then we may actually have a soft landing for this cycle. Now, one of the beautiful things about this cycle is the overvalued areas of our markets is really big tech. They have the market weighting in the S&P, so they are obviously driving the bulk of the returns. But if we see, that catch up from the rest of the markets, there's a lot of value to be stripped out of those, smaller cap companies, those mid cap companies. Those companies could go up multiples of where they are today. And that's why I do think we are probably in a stock pickers market for, maybe the next year or two. Now take a listen to this clip on CNBC from Stephanie Link that says, after election volatility, markets will rally through year end, which again, I do think is about a 50% probability. And I do think overall in markets, we do have a pretty balanced risk to reward. There's a very strong bull case from now until the end of this year. There's a strong bear case as well. It really depends on what happens with the election. Now, I do think the bull case is not in big tech. It's not in Mag 7. The bull case, if there is going to be the bull case that is realized, is really with a broader market rally.
Take us to our talk of the tape. 2 months to go for stocks and a very big week ahead with the election and the Fed meeting looming large. Let's ask our panel what's really at stake. Stephanie Link of Hightower Advisors, Greg Branch of Branch Global Capital Advisors, and Ayako Yoshioka of Wealth Enhancement Group. Steph and Greg are CNBC contributors. It's good to have everybody with us. Nice to see you back here.
Good to be
with us, Mr. Branch. So, what's your current view of the market?
So it's still neutral, and other than the election, I'm really searching for a catalyst to believe in, either negative or positive. Now, when we look at the election, of course, there's some de-risking here that goes on no matter what the outcome is with one candidate. On another level down, when you transition from candidate to elected official, we get to weed out some of the rhetoric and noise that was never going to make it into policy anyway. So I think that that's a de-risking event as well. And then thirdly, both of these candidates have been in office before. So we know what sectors and industries they've been supportive of and where we might see a very particular and specific tailwind.
So you've been willing to stay neutral, I think, for a while, right? In the slow lane, so to speak.
Right.
All this traffic's been passing you in the left lane.
It has.
And why have you refused to hit the pedal and join the rush? Because you've missed out, obviously, on a good amount of this rally, this bull market.
I think my answer is typified by some of the market activity we've seen over the last months. And that is, the data's still kind of mixed, Scott. So earnings growth for 5 straight quarters is great. However, this quarter is at 3.6% as opposed to last quarter's 13%. That bears some watching. On the inflation front, obviously we continue to experience disinflation, and it remains a topic that most don't want to talk about. However, the core number has shot back into the 30 basis points range for month-over-month core growth for the last two months now. So wherever I look, there's data that makes me optimistic, but still things that give me pause for thought. And I think I'll become more bullish when I find multiples and consensus expectations leaving room for outperformance. And I just don't see that right now.
Steph, what do you make of that?
Well, I think we should applaud 2.8% GDP growth because that's above trend, well above trend. I think the labor market, it's softening, but it's still on balance for the most part. If I look at ADP and initial jobless claims, if I look at the 3-month moving average for non-farm payrolls, you're at 140 versus 258 a year ago. So I understand that we are certainly slowing there. And that's the reason why we have a Fed that is embarking on a Fed cut cycle. We have lower inflation at an employment cost index at 0.8 this week, which was less than expected, a PCE at 2.1, and consumption, the consumer is hanging in there. To everyone's surprise, look at final sales to domestic purchases up 3.2%. That is a very healthy number. And of course, you have this manufacturing renaissance, and all you need to do is point to Eaton, Quanta Services, GE Vernova as examples of this renaissance, anything tied to the grid and power and electrification. And that, of course, is tied to AI. So I added up and I see total revenues at 5% and earnings right now on my numbers are up 9%. So I think that's very healthy. I think we have some volatility into next week. We got a lot going on, but I think that's once we get through it, I think we rally in November and December as people chase because they're underperforming and you've got $6.4 trillion in money markets.
Greg, earnings versus a year ago are up 8.4%. I'm not sure where your number is
FactSet has
coming from, but
S&P only numbers at 3.6.
Here's what I think the bottom line is that the economy is undeniably good.
Yeah.
Right?
Great.
Okay. Well, because you said the data's mixed in total. It's not really mixed.
Let's stop there for a second, because I second a lot of what Stephanie said. You know, not only is GDP great, right? But the third quarter doubled. The second quarter doubled the first quarter number. The third quarter number is going to show acceleration as well. But to what extent is it too good is my concern when we see the core number jumping back into the 30 basis points. Look, I'm not the only one who is concerned that perhaps they moved too far too fast. Right,
and they did one hike of 50 basis points.
I gotcha, and here we are back in the 30 basis point core month over month again. So my bet is it'll be 25 for the next cut, and the concern will be let's make sure that it doesn't accelerate from there.
I actually loved that clip because it felt like a good mix of things. He's basically saying, I mean, if we're already expecting things that are really good, the odds of getting something even better than that are pretty low compared to disappointing expectations. And I think that's just something you don't hear right now on Wall Street, and one of the more problematic issues with markets. And that's why I do think if we get a rally, it's not going to be really an S&P headline driven rally. It's going to be a broader market rally, which a lot of the 493 stocks in the S&P exclude big tech. Even if they rally, if big tech does not participate as much, you're not going to see much of a movement to the headline S&P. And that would be my forecast if I were to make some kind of prediction. So let me know what you guys think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.